Something shifted in the gold and silver markets this week. Something that has only happened 4 times in all of recorded human history. And if you don't understand what's moving beneath the surface, behind the headlines, behind the price tickers, behind the central bank statements, you are about to watch one of the greatest wealth transfers of the modern era happen without you. Because what we just witnessed in precious metals is not a rally. It is not speculation. It is not retail investors chasing momentum. It is a signal. The oldest, most reliable financial signal on Earth, and it is screaming right now. Gold crossed $3,100 per ounce this week. Let that number sit for a moment. $3,100. For a single ounce of metal that fits in the palm of your hand. That is not a new high. That is not a milestone. That is a rupture. A breach of a ceiling that every analyst on financial television told you would not happen until 2027 at the earliest. It happened in March 2026. And silver, the metal that has historically followed gold's breakouts with a lag of weeks to months, is sitting at $34 per ounce, coiled like a spring that hasn't been released yet. Here's what nobody is connecting. Here's what the mainstream financial press is not telling you. Here's what the numbers actually mean when you strip away the noise and look at what's really happening. The last time gold moved like this fast, this decisively, this universally, 3 things happen next. Every single time, without exception. I'm going to show you those 3 things. I'm going to show you the historical record. And then I'm going to show you exactly where we are in that sequence right now, today, this week, this month, so you can decide what to do before the window closes. Let me give you the data first. Cold, verifiable numbers. Because until you see the full picture, the individual pieces don't make sense. Gold performance, up 18% in 2026 alone, up 47% over the past 14 months. The metal has posted gains in 11 of the last 13 months. This is not volatility. This is a sustained, deliberate, institutional-level repricing. Silver performance, up 22% over the same 14-month window, but still trading at a gold-to-silver ratio of 89-1, meaning it takes 89 ounces of silver to buy 1 ounce of gold. The historic average of that ratio going back 500 years is 47-1, which means one of 2 things is true. Either gold is massively overpriced, and every central bank on Earth is wrong, or silver is massively underpriced, and the math says it's the second one. Central bank buying. Global central banks purchased 1,136 tons of gold in 2023. Then 1,045 tons in 2024. Then in just the first quarter of 2026 alone, January through March, the pace has accelerated to an annualized rate of over 1,300 tons. China, Russia, India, Poland, Turkey, Kazakhstan. Every major emerging economy is converting dollar reserves into physical gold at a pace that has never been recorded in the post-Bretton Woods era. The COMEX, the exchange where gold futures are traded in New York, saw physical delivery requests spike 340% in February 2026 compared to the prior year average. People are not just buying paper gold, they are demanding the actual metal. Fort Knox has not been independently audited since 1953. The U.S. Treasury claims it holds 8,133 tons of gold. That claim has never been verified by an outside party in 73 years. The U.S. national debt hit $36.2 trillion in March 2026. Interest payments alone now consume $1.3 trillion per year, more than the entire defense budget, more than Medicare. The government is borrowing money to pay the interest on money it already borrowed. These numbers are not separate stories. They are the same story. And the story is this: the world is losing faith in paper and moving into metal. And it has happened before, 3 times. And each time, what came next made early movers extraordinarily wealthy while everyone else watched from the sideline. Here's what nobody is connecting. There is a pattern, a sequence that repeats across centuries, across empires, across completely different economic systems. It doesn't care about technology. It doesn't care about innovation. It doesn't care about which political party is in power. It runs on one thing: trust. Specifically, on what happens when trust in paper money starts to break. The pattern has 4 phases. Phase 1 is stability. Hard money dominates. Gold and silver trade in a narrow range for years, sometimes decades. The currency is trusted. Debt is manageable. Central banks are credible. During this phase, precious metals are boring. Nobody writes headlines about gold. It just sits there, holding value, being ignored. Phase 2 is the trigger. Something breaks the trust. A war, a debt spiral, a currency debasement, a political shock. Gold and silver begin moving, slowly at first, then with increasing urgency. This phase lasts 12 to 24 months, and most people miss it entirely because it looks like noise. Analysts explain it away. Financial television calls it a flight to safety that will reverse. Phase 3 is the repricing. This is the violent part, the part that happens fast, the part that creates generational wealth for those positioned correctly, and generational regret for those who weren't. Gold and silver don't just rise, they reset, to a new fundamental level that reflects the actual loss of confidence in the currency system. This phase typically produces 200% to 400% gains in 18 to 36 months. Phase 4 is the new normal. The metals stabilize at their new higher level. The currency that caused the crisis is either reformed, replaced, or permanently weakened. The wealth transfer is complete. Those who held metal through the repricing find themselves in a completely different financial position than those who held paper. We are in Phase 2 right now, and Phase 3 has already started. Let me prove it with 3 historical examples. Different centuries, different empires, same sequence, same outcome. Example 1. The United States, 1971 to 1980. On August 15, 1971, President Nixon closed the gold window. The US dollar was no longer convertible to gold. Overnight, every currency on earth became pure paper, backed by nothing but government promises. In August 1971, gold was $35 per ounce, fixed by government decree. Silver was $1.55 per ounce. For 2 years, almost nothing happened. Phase 2, the slow accumulation, the quiet repricing. Most investors ignored it. Analysts called it temporary. Then Phase 3 arrived. Gold went from $35 to $850 per ounce between 1971 and January 1980. A 2,329% increase in 9 years. Silver went from $1.55 to $49.45 per ounce in the same period. A 3,090% increase. The people who bought gold in 1972, when it was boring, when analysts were dismissive, when nobody was writing headlines, multiplied their wealth 23 times. The people who waited until 1979, when it was on the front page of every newspaper, bought at the top and spent the next decade recovering. The trigger was the destruction of the gold standard. The repricing reflected the true value of what the dollar had become, a government promise with nothing behind it. Example 2. The United Kingdom, 1999 to 2011. In May 1999, the British Chancellor of the Exchequer, Gordon Brown, announced that the UK would sell 415 tons of its gold reserves. He telegraphed the sales in advance, the single most strategically destructive decision in the history of British financial policy. Gold fell to $252 per ounce, the lowest price in 20 years. This moment is now called Brown's bottom, the absolute low, the point of maximum pessimism. Silver hit $4.95 per ounce. Over the next 12 years, through 2 recessions, the 2008 financial crisis, and the explosion of global debt, gold rose from $252 to $1,920 per ounce, a 662% increase. Silver rose from $4.95 to $49.51 per ounce, a 900% increase. The investors who bought at Brown's bottom, when the headline was, "Government sells gold," and every commentator called precious metals obsolete, made 9 times their money in silver. 9 times. In 12 years. The trigger was loss of institutional faith. When governments start selling their gold reserves, the smart money reads it as a signal of weakness, and buys. Example 3. China and India, 2000 to 2020. This one is different because it's not about a single crisis. It's about what happens when 2.8 billion people begin accumulating wealth simultaneously and instinctively reach for the same asset their cultures have trusted for 5,000 years. In 2000, India imported 600 tons of gold per year. By 2020, it was 800 tons annually, despite import restrictions and punishing tariffs. China's gold consumption grew from virtually zero institutional buying in 2000 to 1,400 tons of demand per year by 2020. The People's Bank of China went from negligible gold reserves in 2000 to being the world's largest single-year buyer by 2023. This wasn't speculation. This was 2.8 billion people voting with their savings for the oldest store of value in human history over the paper promises of Western governments. During this 20-year accumulation, gold rose from $273 per ounce in 2001 to $2,075 per ounce in 2020. A 660% increase driven not by crisis, but by demand. Structural, permanent, demographic demand that is still accelerating. 3 examples. 3 completely different triggers, 3 completely different time periods. Same outcome, same sequence, same beneficiaries. Now let me show you exactly why today. This week, this month, is Phase 2 transitioning into Phase 3, and why the window is closing. Here is what happened in the last 90 days, and here is what it means. January 2026. The Federal Reserve holds rates steady despite political pressure from the White House to cut. Markets interpret this as, inflation is not under control. Gold responds, up 6% in January alone. Silver follows, up 4%. The professional money starts moving. February 2026. COMEX physical delivery requests spike 340% year over year. This is the critical signal. When investors stop accepting paper gold and start demanding physical delivery of actual metal, it means one thing. They no longer trust the paper system to honor its obligations. This is what happened in 1971. This is what happened in 2008 before the crisis hit the headlines. March 2026. Gold breaks $3,100. Not as a spike, not as a flash, as a sustained, volume-confirmed breakout with central bank buying accelerating simultaneously. China announces its 16th consecutive month of official gold reserve additions. Poland's central bank moves its London-stored gold back to Warsaw, physically repatriating national reserves. You do not move gold across borders unless you are worried about who controls it. Check. Loss of confidence in paper. Confirmed. Check. Central bank physical buying at record pace. Confirmed. Check. Physical delivery demand spiking on futures exchanges. Confirmed. Check. Dollar purchasing power declining despite official intervention. Confirmed. Check. Political pressure undermining Fed independence. Confirmed. Check. Mainstream narrative calling this a temporary rally. Confirmed. Every single characteristic of Phase 2 transitioning to Phase 3 is present. Right now. Today. And here's what nobody is talking about. The silver number. The gold to silver ratio is 89-1. In every single previous precious metals bull market, this ratio has compressed dramatically during Phase 3. In 1980, it fell to 17-1. In 2011, it fell to 32-1. The compression happens because silver is smaller, more volatile, and responds to industrial demand simultaneously with monetary demand. If the ratio simply returns to its 500-year historical average of 47-1, while gold stays at $3,100, silver goes to $65 per ounce. That's a 91% gain from current levels. If the ratio compresses to 2011 levels, silver goes to $96 per ounce. And if this cycle resembles 1980, silver could reach $182 per ounce. That is not a prediction. It is a mathematical outcome of ratio reversion to mean, and it has happened before. 3 times. The window is closing. Before we talk about positioning, let me destroy the 3 objections that are sitting in your mind right now. Because until you release these mental models, you cannot act clearly. Objection 1. Gold and silver have already run too far. You missed it. The gains are priced in. Wrong. Catastrophically wrong. Let me show you why. In 1974, gold hit $200 per ounce. Every analyst said the run was over. Too far, too fast, pricing in too much fear. Then gold went to $850 per ounce by 1980. The people who said too far in 1974 missed 325% more upside. In 2009, gold hit $1,000 per ounce. Every analyst said the crisis was over. The safe haven trade was done. Gold went to $1,920 by 2011. The people who said too far in 2009 missed 92% more upside. The pattern doesn't top out when analysts feel uncomfortable. It tops out when the underlying monetary dysfunction is resolved. The U.S. national debt is $36.2 trillion and growing $8 billion per day. The monetary dysfunction has not been resolved. It has accelerated. Objection 2. Crypto has replaced gold and silver. Bitcoin is digital gold. The metals are obsolete. Here's the problem with that thesis. In January 2026, during the most significant institutional flight from paper assets in recent memory, Bitcoin fell 18%. Gold rose 6%. When institutions need a crisis hedge, not a speculation, not a risk asset, not a technology bet, they reach for what has worked for 5,000 years, not 15 years. Gold has been the reserve asset of governments for longer than recorded history. Bitcoin has been through exactly one full global credit cycle. The data does not support equivalence. And central banks, the largest holders of reserves on Earth, are buying gold at record pace. No central bank is buying Bitcoin as a reserve asset. Objection 3. The US dollar is too dominant to be dethroned. Gold rises when the dollar falls. The dollar isn't going anywhere. You are correct that the dollar is not going anywhere, immediately. But you are confusing reserve currency status with purchasing power. The dollar's share of global foreign exchange reserves has fallen from 71% in 2001 to 58% in 2024. It is declining, slowly. Then suddenly, which is exactly the pattern of every reserve currency transition in history. Gold doesn't require the dollar to collapse to go to $5,000 per ounce. It only requires continued, steady erosion of confidence, which is already happening, which the numbers already confirm. Those are the objections. Destroyed by data, destroyed by history, destroyed by mathematics. Now let's talk about what you actually do. Same person, same starting wealth, different understanding. Watch what happens. Meet David, 41 years old, $180,000 in a 401k, 80% US equities, 20% bonds. $25,000 in a savings account earning 4.5% interest. A house worth $420,000 with a $280,000 mortgage. Zero exposure to precious metals. David reads the financial news. He knows gold is up. He thinks it's interesting but assumes he's too late and doesn't know enough to start. Over the next 24 months, the Phase 3 repricing continues. Gold reaches $4,800. Silver reaches $78. The dollar's purchasing power declines another 14%. David's 401k, denominated in declining dollars, shows nominal gains but loses real purchasing power. His savings account's 4.5% yield is eaten entirely by real inflation running at 7%. His net worth in nominal terms stays flat. In real terms, in actual purchasing power, he loses 12% of his wealth. Not because he was reckless, because he didn't make a decision. And inaction, in a monetary transition, is the most expensive choice you can make. Meet Sarah, same age, same starting wealth. She spent 6 hours studying the historical pattern. She made 3 changes. She moved $25,000 of her 401k into a gold and silver ETF. Not all of it, just 14% of her retirement account. She bought $8,000 of physical silver at $34 per ounce. And she kept the rest of her portfolio unchanged. She didn't panic. She didn't bet everything. She just repositioned one corner of her financial life based on what history said was coming. Over the same 24 months, Sarah's 14% precious metals allocation in her 401k triples. Her $8,000 in physical silver becomes $18,400. The rest of her portfolio performs identically to David's. Her total net worth increases by $42,000 in real purchasing power terms, while David's declined by $21,600. Same starting point. Same job, same income, same house. Different understanding of a pattern that history has shown us repeatedly. The difference between David and Sarah is not intelligence. It is information. It is knowing that the gold-to-silver ratio has only been this extreme 3 times in the last century, and that every single time it compressed, silver outperformed every other asset class. That information is now in your hands. Let me tell you what to watch. Because you cannot time this perfectly, nobody can. But you can watch for the signals that confirm Phase 3 is accelerating and position accordingly before the move becomes obvious to everyone. Signal 1. Gold sustaining above $3,000 per ounce. Not spiking to $3,100 and retreating. Sustaining. Trading at $3,000 as a floor, not a ceiling. We are watching this signal right now, in real time. Every week it holds confirms the repricing. Signal 2. The gold-to-silver ratio dropping below 80. When silver starts outperforming gold, when the ratio compresses from 89-1 toward 80-1, that is the signal that institutional money has moved from the defensive trade into the aggressive trade. Silver outperformance historically marks the middle of Phase 3, not the end. Signal 3. A major central bank announcing formal diversification away from dollar reserves into gold. Not China, they're already doing it quietly. Watch for a NATO-aligned economy, a Japan, a South Korea, a Germany publicly adding gold to reserves. That would confirm that reserve currency transition is no longer a fringe thesis. It is official policy. Signal 4. Physical shortages at retail level. When the US Mint, the Royal Canadian Mint, or the Perth Mint begin announcing allocation limits or delays on silver eagles, maples, or kangaroos, that is demand overwhelming supply. It happened in 2020. It happened in 2008. When it happens again, the paper price will follow the physical price upward with velocity. Watch for those 4 signals. The first 2 are already partially present. When 3 of the 4 are confirmed, Phase 3 is in full force, and the window for low-cost entry will have closed. Let me end with the only thing that matters. The pattern does not care about your opinion of it. It does not care whether you find it compelling or unconvincing. It does not care how busy you are or how many other things compete for your attention this week. It runs. And it has run, without interruption, without exception, without mercy for those who weren't watching. Through Rome, through Weimar, through the British Empire, through 1971, through 1999, through 2008. Every single time the underlying monetary math became unsustainable, the same assets preserved wealth, and the same assets failed. Gold has been money for 5,000 years not because of sentiment, not because of tradition, because it cannot be printed, because it cannot be debased, because it answers to physics and geology instead of to politicians and central banks. Silver has been money for 5,000 years for the same reason, and trades today at a ratio to gold that historically has only preceded explosive outperformance. You have 2 choices. You can wait for this to be on the front page of every newspaper, on the tip of every financial commentator's tongue, in every conversation at every dinner table. That is when Phase 3 ends. That is when the window closes. That is when the wealth transfer is complete, and you are on the wrong side of it. Or you can look at the data, look at the history, look at the signals that are blinking right now. The record central bank buying, the COMEX physical delivery spike, the ratio compression beginning, the dollar erosion continuing, and decide that you understand what they mean before the crowd does. The pattern is not coming. It is here. It has been running for 14 months, and the next 24 months will determine whether this was the most important financial decision you made in this decade or the most expensive mistake you didn't make. The gold to silver ratio is 89-1. The historic average is 47-1. The math is the math. The history is the history. The signals are the signals. What you do next is up to you. Subscribe now, because the next video breaks down exactly how to build a physical and paper precious metals position from scratch, regardless of your starting budget. Step by step, historical data, no hype. The window is closing, and it does not reopen.